This episode is brought to you by Koifin. Koifin is one of the fastest growing platforms for financial data and analytics to research stocks and understand market trends. Imagine a Bloomberg Lite with tons of high quality equity and macro data, a powerful graph engine that can show it all clearly, and a user interface that doesn't look like it was built in the 1990s. If you're an individual investor, research analyst, portfolio manager, or financial advisor, do yourself a favor and check them out. You won't regret it. Sign up for free at koifin.com. That's KOYFIN.com.
Hit it.
It's Friday, October 8th, 2021, episode 152. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show the Convexity Maven himself, Harley Bassman. We take a tour of bond trading during the golden age of liar's poker. And while we are at it, we find out why Harley thinks rates are headed higher in the coming years. Then Patrick, fresh with his purchase of the Crayola of Destiny, uses all his skills learned from the recent International Alliance of Technicians meeting to tell us where markets are headed in today's episode of Talking Charts.
This week in trading history, we go back to the Wells Fargo purchase of Wachovia, and then we end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show.
Okay, now before we jump into this, Patrick, we have something that we have to tell everybody.
Yes.
So, for those who don't know, Lena is getting married. So, Lena, hop on.
Congratulations.
Hi.
Hi. Congratulations, Lena.
Thank you.
And you're getting married next week.
That's
right.
right.
So, Patrick has so graciously allowed you to take the week off. And we just wanted to let everybody know that we are going to have our first we're just not going to have an episode next week. We're not going to have an episode. And I think everyone will understand. And we all wish Lena a great week off. And we'll see you guys in a couple of weeks. But I just wanted everyone to realize that we do have a good excuse. And make sure that you guys go and reach out and tell Lena how happy you are that you're not getting a Market Huddle next week.
There you go. But it is, so next episode will be October 22nd. All right. So, and nonetheless, Lena, what beer are we drinking this week?
So today we're drinking, let me see if I can say this right, Borshadi Mester Lager.
Oh, so good.
Again, the Hungarian lager.
So well done.
I really tried. I practiced.
I thought it was really well done.
Again, Kristan sent this to us. So when I was out there, so Lena, give us a description.
So Borshadi Mester is a full-bodied, unique taste and unique aroma, golden 5% alcohol quality beer. It is made using a traditional brewing process using 2 types of malt and 2 types of hops. So this was translated from their website. Fun fact, the brewery I'm assuming the place is called Borshad, was founded during communism in 1973, and it has been bought after the regime change. Now it belongs to Molson Coors.
That's why I like it, because I already like it. It's already a great beer.
There you go.
Anyways, kidding aside, Lena, just one last time, I just want to say thank you. I'm sure that all the market huddlers will be wishing you well and having a well-deserved week off, and all the best to you and Luke in your new lives.
Thank you.
So, Kev, give us a disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the prop trade poops, fiat feverish, I can't even say that, laser-eyed lesions.
Oh, I wouldn't want those. I got to stop listening right now. Anyway. All right, let's get to the interview with Harley.
It's our great pleasure to welcome back to the show Harley Bassman, a.k.a. known as the Convexity Maven. Thanks for joining us again.
Thank you. Good afternoon.
Now, since we've spoken last, you've not only are you the Convexity Maven, but you actually have a new role. Why don't you tell a little to people that aren't familiar with your new role, what you do, and where you've ended up?
Well, about 6 months ago, I joined Simplify Asset Management. It's a year-old company. I'm employee number 10, so I get to brag to my kids I'm a startup. And
Harley, before you go, are they impressed by that?
Of course not. So I'm very little impressed with these kids nowadays. In any case, it's an ETF issuer. It's a year old, and we have almost $800 million under management, including an ETF that I created, which has about 110 million of assets right now, which we could talk about a little later on.
Okay.
And the unique feature of Simplify, which is why I joined and kind of came out of retirement, is that most ETFs that use products or options or derivatives, they're selling optionality, selling convexity. They're trying to go and find ways to enhance the yield, the dividend, the payout of a product. They do that at the expense of performance. So when you sell a call option on an asset, you take in money up front, you increase your yield, your dividend, but also you've capped your upside. Simplify is the other side of that trade, where we buy optionality, we buy convexity into our products to enhance the performance. And the give up, of course, is that there's a small burn of the option premium if markets don't move. Nonetheless, markets have moved quite a bit in the last few years, so that has not been an issue. But in theory, if markets were dead unchanged for a year, our products would perform a little less favorably.
The perfect place for the Convexity Maven.
Exactly.
Right. Okay, so the reason we have you back on the show is that I guess when you launched that product, and we will talk about it towards the second half, but when you launched it, I reached out and we were chatting about how you price it, and we were going through the Bloomberg, and you were helping me out with I'm the farthest thing from a swaption trader, so I needed some help on how to go through it. And you started telling me some stories about your days trading all the different aspects of arbitraging, let's say futures versus cash and all sorts of, different options and just your life. And I said to you, Harley, you got to stop telling me these stories. We got to do it on air. So the whole purpose of this and what the first half was, what I'd love to do is to jump back in and go through those stories. Now, let's start off with the cash futures arb. And why don't you explain to people what that is? And I think that a lot of people take it for granted, but there was a time when it was very popular trade on Wall Street on the proprietary desk that made lots of people lots of money. And there's a whole myriad of stories. So let's just jump in. Why don't you tell people what it is to start with?
Well, there are a few books I recommend on Wall Street. One of them is called The Yield Book by Homer Leibowitz. That is the bond Bible. It's still in print. I urge you to read that. Another book that's interesting is Liar's Poker. Michael Lewis book, I think it was his first book. And this talks about the Solomon Brothers arbitrage desk and the mortgage guys there. And this story is all true. And I will say it's true because I wasn't at Solomon, but I was at Merrill Lynch. And I was there for all this stuff. And I know most of the people in that book. And Solly Arb, they're talking about these guys playing poker, holding cards to their heads and everything else. The genius of these people was that they figured out that there's a difference between buying a product, corn, bonds, soybeans, gold, buying it today or buying it 3 or 6 months from now in the futures or forwards market. And it seems that people, ordinary civilians, did not really understand or appreciate that difference. And Solomon Brothers figured it out. And they were able to do transactions in very large size to squeeze out what became pennies, but at the time was dollars, like big dollars. So a simple example is this. Let's say you have a bond at 100 and it has a 5% coupon. So you make 5% per year. And let's say you could borrow money at 2% per year. Well, that means you're going to make 3 points per year owning that bond. Forget the price movement. Right. You're making 5 on the coupon. You're paying out 2 to borrow the money, to finance it. So a fully financed position. If you bought this bond today, you take all the price risk and you make 3 points. Let's say you bought a futures or forward to buy this bond a year from now. So you've agreed to buy the bond a year from now, but you don't get any of the interest. You don't get those 3 points because you haven't bought it yet, but you have all the price risk. what price will you buy that bond at? I'll save you pulling out your calculator. The answer is 97 because you're giving up the 3 points.
Right.
And it's very easy to figure out that price if you know the coupon and where you could borrow money at and everything else. Well, it turns out that futures contracts might be trading at 98, crazy as it might be. And so Solomon would go and buy the bond, borrow the money, sell the future at 98, and then make that 1 point difference over time.
Come on, it wasn't that easy, was it?
It really was. Yes, it really was.
So when was this that it was that juicy?
Mid 80s.
Sorry, go ahead.
I would trade mortgage bonds. So you'd have, once upon a time, it took a long time to borrow money. And therefore, a mortgage banker might create a bond today, but the actual loan would not be closed for maybe 3 or 4 months because it took time to do all the work. It was before computers. So the question is, and they want to go sell that bond today and get rid of all their risk. Where do they sell that bond? Well, they sell it in the mortgage market where we trade in forward contracts. So right now, you can trade an October mortgage. You still can. They still exist. They're called TBAs, to be announced.
Okay.
You'll get a bond that's to be announced on the settlement date. So they have October, November, December, January forwards going out. Well, where would they sell it at? Well, Wall Street would go and buy or sell. We'd figure out where to buy and sell it, and that would be that. Well, clearly there's a spread once again between, a cash mortgage bond and a forward. And sometimes and we might go to an S&L. And let's just say once again that this, I'll use the same example, a 5% mortgage bond. You could borrow money at 2%. Ignore prepayments and the other nonsense out there. Let's keep it simple. And I could, in theory, get this bond. I can get the bond at 97 a year forward. Well, I might go to a bank in Iowa and say, "Hey guys, bonds are trading here at 100 today. Tell you what, I'll sell you the bond a year from now at 97 and a quarter, 97 and a half." They go, "Wow, why would you possibly do that? Bonds are 100." But these are real banks with real money, and they're regulated and everything else. And they would buy the bond for me at 97 and a half. And lo and behold, I make a half point. Now, these were not, billion-dollar tickets. They were like onesies and fivesies.
Okay.
And we're talking, the mid 80s here, before you had all this stuff. Or you would do an option trade based on that. Right. And so I might go and buy a put option from them for the right to struck at 98, but the real market's 97. So I'm actually buying a 1 point in the money option at a price. This was not robbery. It wasn't like I was cheating people. There was the market traded. There was bonds available on the brokers markets. It's just there was people didn't understand how these things worked, and you had risk management tools that were insufficient to appreciate how pricing worked for these things. And also you had regulations also.
Now, so this is in the mid 80s. People are doing this on prop desks, and the smarter traders are figuring this out. What eventually changes? Is it the clients smartening up to it? Does it attract more competition?
It was lots of things going on. One was that you had more guys coming into the market. Originally in the mortgage market, it was Solly and a few other people, and then the Solomon Brothers team got busted up, and they went to Merrill, they went to Payne Weber, they went around, and they took the knowledge with them. We started getting computers that could go and do the calculations. Once upon a time, I owned a thing called a Monroe Trader.
Oh yeah, for sure. I've heard of that.
It's the size of a small toaster. I still have mine from the mid 80s. I'm not sure I'm going to sell it to, but I still have it. And this Monroe Trader, the size of a toaster, it did one thing and one thing only: figure out the yield to maturity. That was it.
Right.
People nowadays don't have a concept of what we're talking horse and buggy times now in finance. And so you had, and then you had regulations also. Banks were allowed to buy or not buy certain products back then. There was much more regulated, especially before the '89 S&L crisis.
Oh, I see. So you weren't competing with J.P. Morgan. They couldn't be there. The actual banks weren't your competition. It was only dealers.
Yeah, that's true. Yeah. So I mean, people forget that before 1989, 1990, you had S&Ls, savings and loans, and you had commercial banks, and they were created. And this is like It's a Wonderful Life. Remember, Jimmy Stewart? He had an S&L.
Yeah.
S&Ls were made to make loans to buy a house. Commercial banks, word commercial being business, right? Were there to make loans for businesses, and they were kept separate. And there were actually regulations that fixed the amount of money a bank could pay on interest for like your savings account, your passbook account. And S&Ls were allowed to charge a quarter point higher or pay a quarter point higher interest to attract money as a way to bring money into the housing market.
Okay. So that they could attract. Oh, and that was the attraction. That's why people started S&Ls, because they could do that.
It was government policy to go and make loans, make money available for homes,
Right.
home loans. I mean, it still is government policy. I mean, why do you think we have deductible home mortgage rates? I mean, it's a public policy good to have people own their own housing. That's why you have Ginnie, Fannie, and Freddie. These things didn't come out of thin air. There is a public policy good behind these things. And those were it.
And so why don't you tell us a little bit about so the S&L crisis? When did it come to a head? Like when was that? I'm just trying to think. That was before the long-term cap. That was before Liar's Poker, and that was in the late 80s.
No, actually, S&L crisis hit in '89. Liar's Poker, I think, was '87.
Oh, okay. So it was before. Okay. And the problem was that they had attracted all of this money, and they had, in essence, had kind of just almost bozos running all these S&Ls. And weren't there some famous trades that came out of that as well, in terms of guys going and picking these guys off? Didn't they call them the 363? Borrow at 3, lend at 6, and be on the golf course by 3?
More or less.
Yeah.
Well, I mean, that was the case, that you had a steep yield curve that was managed by the Fed, and S&Ls would lend out money at 3, 4, 5%, and borrow money at that price and lend it out at 8, 9%, and they make money. What happened was this, and once again, I guess it's good deeds gone asunder, and be careful what you wish for. Paul Volcker, the S&Ls finance themselves all with short-term money.
Okay.
Passbook accounts. They're called passbook accounts because once upon a time, before they had computers, you would get a little like 3 by 4 inch leather-bound booklet, and that's where they kept. That's how you kept track of your money. And you'd go to the bank, and they'd write the money in, they'd stamp it, and you'd walk out with it. There was no computers back then. And so that's what they're called, passbook accounts. And then they lend money out for homes at, 8%. What happens when Paul Volcker all of a sudden takes the front end from 3 up to 20?
Yeah, they're done.
Basically, every S&L goes immediately bankrupt because they're now borrowing money at 20,
right,
and taking in 8%. And so
it's actually just shocking to me that there was so little risk control, and it was just as simple as that. They just assumed that everything would be fine, and that the conditions would never change.
Well, I mean, theoretically, if it was done slowly, there'd be time to go and lend money at higher and higher rates, and everything. It has to happen so quickly. Also, there's a whole lot of things going on. There's not one thing, but that S&L's got cooked with that. And all of a sudden, they're kind of theoretically bankrupt if they marked everything to market. So what the government did was this. They went and said, okay, we're going to give you guys leeway to do stuff, to do more things.
Right.
And one of the things they allowed them to do was to buy junk bonds.
Okay.
And this tied up nicely with Mike Milken.
Right, at Drexel.
Coming to the market. Yeah, and Drexel, yeah.
Yeah.
So they started buying junk bonds, and then when you had the recession in '89, all of a sudden the junk bonds went to zero or went down from par, and you saw S&Ls going into bankruptcy.
That was it. Okay.
And that's when the government came in and they said, okay, commercial banks, please come buy all these S&Ls. And there was basically all these forced marriages.
Right.
And up until that time, banking was only done in state. You could not cross state lines.
Ah.
And this is actually the beginning of Bank America, because Bank America was actually, I think it was called, at the time it was called NCNB, North Carolina National Bank, and they bought Texas Commerce Bank shares. And that's how NCNB got into Texas. And then from there, you saw all these walls start coming on down. But that's how it happened. Was basically trying to save the S&Ls because the government didn't want to foreclose on them and pay everything out. So they had the stronger commercial banks take them all over.
Okay. So let's get back to the futures arb, because not only is there the element of the forward part of the pricing, and you've explained to how they misprice that, there's also some optionality in terms of what you can deliver into that contract. Why don't you explain to people how that works, and has the market got more sophisticated? I believe there was still some arbitrage available for the more kind of shrewd participants who understood this optionality.
This was one of the very fun little tricks about futures contracts. What they do, and they still do, for the Chicago Board of Trade, is you have, let's say, your TY, your 10-year futures contract. That's the most active one out there. It's actually not a 10-year contract. It's actually a 7-year contract. And the reason why is there's lots and lots of bonds out there. And you can't make a contract where you only deliver in one security. So they'd say, okay, everything between, 6.5, 7 years and 9.5, 10 years, all of those things can be delivered into this contract. But you got to go find an adjustment, don't you? It's kind of like sweet crude versus sour crude going into oil contracts. You got to go and make adjustments for quality. And so what the board did was they said, okay, we're going to go and adjust by coupon, so the coupon rate, and by the maturity, because an 8-year bond is riskier than a 7-year bond. And there still is a book. It's called the factor book, and it gives you the conversion factor for every single possible scenario of every maturity and every coupon. And that number would then, adjust the price you would get. So you take the futures price times the conversion factor would give you, the price you would deliver your bonds in at what you get paid. The small detail is this is why I recommended the book, the yield book, is that duration, the measure of risk in a bond, requires 3 inputs: coupon, maturity, and yield level. It makes a difference if you have a 5% bond, if rates are 2%, 5%, or 8%. The thing is, the Chicago Board of Trade only had 2 factors: coupon and maturity.
Okay, actually, let's actually take a moment and explain to people why it makes a difference. Like, why don't you articulate or kind of go a little deeper there in explaining why the underlying interest rate matters for when you're comparing 2 different bonds?
It matters because let's say you have a 5% bond trading at 100 and rates then go to 6%.
Yep.
And now you could buy a 6% bond at par at 100. Well, that 5% bond still exists, but the price might go up to 92 because you'll have to go, because who wants to buy a 5% bond in a 6% world? And let's make it easy. Let's say the bond goes to 90. Okay? So what that means is if you buy your 5% bond at 90, you'll get your $5 once a year. And then over the 10 years, you'll earn 1 more point every year.
Exactly.
90, 91, 92. And thus you'll earn your 6% yield and you're all happy.
Right. So it's in essence, when you're talking about the yield on a bond, you're just assuming you're going to reinvest at a certain rate. And therefore, what that rate is actually matters.
That's part of it. The other part is this, that when that 6% bond moves, the yield moves, it's moving from 100 to 101 or 100 to 99. The 5% bond trading at 90, well, it's not going to go to 91 or 89 because it's a smaller number.
Right.
So therefore, that differential has to be compared to the other number. This creates convexity in a fixed income, a bond.
Okay.
Any bond out there where you have a coupon that's fixed, a maturity that's fixed, there's no call feature, that bond is positively convex. Not like an option, but it is positively convex. And it's that convexity that the conversion factor does not capture.
Okay.
And thus, when you have a futures contract where there's like 30 or 40 different bonds that can be delivered in, depending upon the interest rate, there's convexity involved in that. And since the guy who owns cash can deliver any bond he wants, he has a delivery option. He can pick any bond he wants to deliver in to the futures contract. He's long an option, and thus the futures contract is short convexity. Is short the delivery option. This matters when? It matters when you're near the theoretical coupon of the futures contract. Futures used to have an 8% coupon. They're now a 6% coupon. They changed it 20 years ago. When you're ever near the coupon, you have negative convexity in that futures contract because as you go from, it's currently 6%, as you go from 6 to 5, you'll see the 7-year bonds delivered. As you go from 6 to 7, you'll see the 10-year bonds delivered, back and forth. So as you go around that coupon, these futures contracts are extraordinarily, well, I won't say volatile, they're scary because you don't know what you're going to get. You can get a 7-year, you can get a 10-year. We're trading at 2% rates right now. That's why you see the U.S. contract, which is like a 20-year, trading at like, 150, 160. 10 years trading at like, 120, 130.
Right.
Because it's a 6% bond.
Yeah. Okay. So when did guys figure this out and how did they take advantage of it?
The Solomon guys figured it out day one, and anyone with and anybody who knew what options figured it out. So all the guys who had Bloombergs and knew what they were doing could figure out the embedded option and price it out and figure out if it was trading rich or cheap. And what there are guys out there who made hundreds of millions of dollars buying and selling futures contracts versus cash instruments as that embedded option got too expensive or too cheap.
And did it usually trade too cheap or too expensive, or did it oscillate between the two?
The option tended to trade too rich, too expensive.
Okay.
So owning futures was a good thing to do because a bigger option. And when you buy the future, you're selling, you're shorting the option because you're short the option. If you're long the future because you don't know what bonds you're going to get, you're short the delivery option. And who else figured this out? It would be, I will not mention the name, but my ex-employer. So you can go to my resume and look me up. And my ex-employer would go out there and instead of buying cash 10 years, would buy futures contracts and then go and buy 3-month T-bills. And effectively, that 10-year contract traded a little cheap because the option was too rich. And that package of owning 10-year futures and 3-month T-bills, I suppose is levered, but it really isn't because there's no price risk in a 3-month T-bill unless you have Paul Volcker at the helm. And you might be able to earn 20, 30, 40 basis points extra by being long futures instead of being long cash treasuries, even if you're a pure treasury account.
Right.
So you have the same risk, but you pick up extra money by selling the embedded option, by buying the futures contract. Now, if you go and earn 30 or 40 basis points, not much, but a little bit, if you earn that extra for 20 years, what do they call you?
The Bond King, maybe?
You got it.
I was gonna laugh and say that it makes sense that that's the position they had, because I've never seen a vol that guy didn't like selling.
That's a different story entirely. That's options on futures, which is
Right.
also an interesting concept. But I mean, this is when, and the reason why it was so interesting for so many years is that most funds were not allowed to trade futures for a variety of reasons. Most of them kind of foolishness. As a matter of fact, until the late 90s, most fixed income, the big fixed income funds, could not even do repo.
Oh,
They could not even lend bonds overnight, because theoretically that is leverage. Because you have a bond you've lent out, you get cash in, so now you have a bond and cash. Well, that's two items, not one item, so that's leverage.
okay.
I mean, I guess it's 1 day leverage, but
Right.
it counts as leverage, and therefore they couldn't do it.
So you had a lack of buyers, and then yet I take it on the other side were people that were using it as a hedging tool, like issuers and things of that. So there was a permanent demand supply shift or
Yep.
imbalance, let's say.
For the most part, yes, that's true.
And then that firm, let's call it the Beach, they figured out how to take advantage of this. And eventually, was it fixed through other regular real money accounts being allowed to trade that?
Yep, that's it. But let's be clear. There was nothing illegal, immoral, or bad. As a matter of fact, it was a public policy good.
Oh, I 100% agree. You were making the markets more efficient, and I'm not even saying that facetiously. Like I completely believe that you guys, by tightening it up and making it a product that ended up being one of the greatest products out there. And without that other side, they wouldn't have had any trading. We wouldn't have been able to have people being able to hedge their risk on the issuers, and it wouldn't have been this product that it ended up being.
And I'll also say that the people who were selling the contract with futures too cheap, they weren't sad either, because they had no other venue to hedge their risk.
Right.
So both sides were happy. It turns out there was a little bit more selling than buying, but I mean, both sides were happy with this transaction. So let's be clear about that. There were guys who made a lot of money, but there was nothing nefarious going on, and it did serve a good public policy purpose.
It's what's shocking to me is that it lasted so long with so much money there.
It just took time. I mean, well, it's not that long, really. I mean, futures contracts didn't exist till 1980, 81 by Richard Sandor. Options didn't start trading till 82, 83. I mean, I got onto Wall Street in August of 83. I mean, I got there within a year of bond options trading, which is, very fortuitous to fall out of school at the exact right time. As I will always say, better lucky than smart. But I mean, these are brand new ideas out there. I mean, until Richard Sandor, all you had for commodities was pork bellies and farm products. I mean, financial futures are relatively new in the scheme of things.
And how do you, I can't remember your story. Were you at Merrill right away? And how did you end up trading these? Did you trade the futures, or were you on the mortgage-backed desk?
I was always mortgages,
okay.
More or less. But I started at Drexel. I went to U Chicago Business School right out of college when you could do that kind of nonsense, and ended up on Wall Street at age 23, which also you can't kind of do anymore, really. I was at Drexel for a year and a half, 2 years, and then ended up at Merrill Lynch in 85.
Right.
And basically our two senior guys, actually 3 senior guys, were all from Solomon, and they were all in Liar's Poker, that book.
And so now, and they confirm that it's all true? Like Michael didn't embellish it in any ways?
There may have been some additions, but I think it was mostly all true. In the same way, the movie Wolf of Wall Street with DiCaprio.
Yep.
I mean, I guess that's a venue for soft porn, which I find, whatever. But and unfortunately, the movie did not have a lot of there wasn't a moral, there wasn't a story like the original Wall Street by Oliver Stone. But that is a very good depiction of reality. There was actually a dwarf who was thrown onto a Velcro chalkboard. This did exist. I mean, all the things you see in that movie, I was there. They all happened.
Oh gosh. Oh gosh. Okay. Let's talk a little bit now about what you see in the current market environment. I know that you have this new product out there, PFIX, which I'll just be honest, I love it. I think it's a great product. I think it's difficult for people to get the sort of long Vega exposure to the swaption market. Why don't you explain to people what it is and why you brought it out?
Well, immodestly, I will say, and modesty never be my strong suit, this is one of the greatest, products brought to civilian Wall Street, in many years. And the reason why is most of the interesting derivative risk control products are only available to professionals, hedge funds, pension funds, commercial banks, broker dealers, and you have to have an ISDA contract to trade these over-the-counter derivatives, options, futures, forwards. And therefore, a civilian can't get them, humans can't get them. And surprisingly, most family offices and small hedge funds, a hedge fund under 100 million probably does not have an ISDA.
Yeah. That was, for those who are interested, ISDA was in that great movie, The Big Short, in the book. That was the one hedge fund that was going around trying to get an ISDA, and they couldn't get it. That was an entire storyline for one of the clients. Yeah.
A small detail: I actually have a personal ISDA, so I can do all these trades. But that's the difference entirely. Anyways, this being able to go and transact in some of these things is incredible, because there's really amazing investments, hedge products you can get from them. And what we did was, at Simplify, is we got an ISDA with the street, a few of them actually. What we did was we have a product where it's $25 of a 5-year U.S. Treasury, and the balance in a 7-year option on the 20-year interest rate struck at 4.25. Okay. That's it. So nothing else.
Why don't you go a little slower and explain to people? So half of it is sitting, in essence, in a safe Treasury bill or Treasury note, a 5-year note, and then the other half you have gone and paid for an option in full, and that option is what again?
In a nutshell, it's a 7-year option on a 30-year Treasury.
Okay.
Struck at 4.25%. It's a straight put option. You bought a put option on a 30-year Treasury, struck at 4.25.
Right, and you do it through the swaption market. It's a little bit different. It's not exactly the Treasury market, because the swaptions do trade it, but in essence, it's designed. It's functionally designed to basically be a put option on 30-year Treasuries. And the thing about this that's kind of interesting is that if you go, and even if you, let's say, trade futures and you want to buy long-dated vol, and you walk out you pull up your UB or even your US contract that trades on the Chicago Board of Trading, you go try to trade anything longer than 9 months, there's almost no market, and there's no listing past a year.
That's correct. There's nothing there.
There's nothing there. Yes, you can go to the TLT and try to trade that, but again, that's not quite the same, and it only goes out a couple of years. This is a 7-year option, so it's filled with tons of Vega. Why don't you explain to people as well? There's another interesting element about this particular market and the way that the volatility sets up, meaning the shape of the volatility term curve, I guess. I don't know how to, why don't you explain to people how that works?
Just to be clear, you can go to my website, convexitymaven.com, and some of my more recent commentaries, I've written about this with lots of pictures and fun colors. To save you that, though, in most products, you will see implied volatility rise as the option gets longer. So a 6-month option has a higher vol than a 1 month, 1 year higher than 6 month, 5 year higher than, and so on and so forth, which makes sense because the level of uncertainty that you have is greater the further we go away from today. Like I know what the Fed's going to do for the next 6 months, but 3 years from now, not really. And so therefore, implied vol, the cost of an option, is proportionally higher. In interest rates, and this is true for foreign currencies, for commodities, for stocks, it is not true for US interest rates. I'm not going to tell you why. I'll just say that implied vol at the 3-month point goes up. When it hits the 2, 3, 4-year point, it hits a peak and then comes down. And so the implied vol of a 7-year option is actually about 8% lower in implied volatility than a 5-year option.
Right.
Thus, when you own the 7-year, which you would own via our ETF, as time goes by, the decay of that option is reduced significantly because the volatility used to price it goes up. So that basically means that this product really, it decays by about, let's call it 6% for the first, about 12% for the first 2 years, which is not that much at all for the option. And therefore, owning an option way out there, it's not like owning your ordinary option that just whispers away quickly. This thing doesn't decay that quickly because of that. Right. And therefore, you get a long view. And you can basically, for the first couple of years, there's not that much cost to owning it. And as you mentioned, you own a significant amount of vega. What vega means is how much does an option price move as implied volatility moves? Well, we're sitting at historic lows in implied vol. Very, very low.
And I'd like to just jump in here and say, if anyone's going to know that, it's you, as being the originator of the MOVE index, which is in essence the VIX for bonds.
The VIX for bonds is what it is, and the moves in the low 60s now. And for most of my career, it averaged 100. That's how far away implied vols are from where they used to be before the Fed kind of clamped down on everything. And so if you buy this product, not only do you get do you win if rates go up, right? But you win if vols go up. And I would suspect that if bad things happen to good markets, you'd get both of those at the same time. Rates up and vols up. So it'd be a double kicker for this thing. And right now at a price of 40, 42, the lowest it could ever go theoretically is 25, because the 25 is the treasury we own. Realistically, it would be hard pressed to go below 30 in the first couple of years because the option value can't go much below $5. Could it, in theory? Yeah, don't hold me to it, but it would be very difficult for it to get below that. So you kind of have, 10 points of downside and many, many more points of upside. And once again, we have a theoretical modeled profile. It's not a prediction. It's a modeled profile on my website.
Okay, so let's talk a little bit about the macro backdrop and why you think that this might be the time to potentially hedge some of your interest rate risk. We've gone through 4 decades of interest rates headed lower and lower and lower. I personally think that that COVID brought about a fundamental change, and there was a change from monetary dominance to fiscal dominance, and that we're about to see a lot more inflation going forward. I'm wondering if you feel the same, and that is one of the reasons that you brought out this product.
COVID accelerated part of my, base concept of what's going on. Do I think rates are going up? Yes. Are they going up tomorrow? No. I think they're going to go up in the next 2 to 3 years. And the reason why is I believe that demographics is the key, not sole or primary or key, but significant driver of interest rates and inflation. And once again, if you go into some of my past commentaries, I have some really nifty charts showing the relationship of the labor force growth rate relative to interest rates. And the reason why, and if you look at the big bulge of rates and inflation in the late 70s, early 80s, this, in my view, was caused by the baby boom generation all of a sudden hitting age 30, 35, getting married, forming households, having a baby, buying a car, buying 2 cars, buying a house, buying a bed and a washing machine. They're buying, when they form a household and they merge their assets, they all of a sudden start to spend more to build this house out. And they're buying these assets from who? The generation behind them. Well, in this case, it was the World War II generation that was depleted for reasons we can kind of guess about. If you follow this labor force growth rate of boomers entering the workforce, it went up and has gone down steadily for the next 40 years. But now, what's going to happen 2-3 years from now? Demographics is baked in the cake. You can't go back in time. We know how many kids have been born. We know what age they will be in 5 years. And what you're seeing happening right now is the millennials, a little bit behind the boomers because they get married later and have kids later, are starting to turn 30. They're going to start to get married. They're going to enter the workforce, and they're going to go and start to buy things. Where are they buying them from? They're buying from boomers. What are boomers doing? We're retiring. We're going to make less goods. And so you have this inflection point coming up over time right now, and where you're going to see the boomers leaving the workforce exceeded by the millennials coming into the workforce. That inflection point starts in 2023, and that's my story. That's why I want a 7-year option, because the 7-year option expiring in 2028 gives me optionality right into the meat of this thing, and I'm buying it now while rates are still very low and volatility is very low. And the plan is I'm not timing the market. I'm going to buy it now because the opportunity is here, and I'm going to sit on for 2 years until it happens to me.
Right. A lot of people, we all hear about the boomers. We hear about how important they are to markets. And if you ask people, what is the largest cohort out there, most people would say the boomers. But when you actually go look at them, just to your point, the millennials are actually the largest size. It's just that they don't own any. They own very few assets right now and aren't that important. But yet, as we have noticed since this COVID, as they've started trading and as they started doing things, they definitely are having an increased influence on markets. That's true. Well, once again, one of my past commentaries, I have a nice picture of the U.S. population demographic. And it's the fact that there are more millennials than there are boomers. But the difference is this. When the boomers were born, the population of the U.S. was smaller. So the boomers were a bigger proportion of the U.S. economy. Okay. So you have more millennials, but a bigger population. So that's how people can say both are true. I see. Okay, and so what else do you see here when you've been around markets for a long time, and here we are, almost 2 years after the March crisis? No, a year and a half since the March COVID crisis. Stocks are up 100%, and now for the first time we see the Fed tapering. We see central banks throughout the world actually raising rates. Are we on the start of a tightening cycle that is going to be quickly snuffed out as the economy or the markets roll over, or does this tightening cycle have legs? It depends what you mean by tightening, because tightening could take 2 forms. One could be taper. They reduce the buying of the back end of the market. Right. 2 is they take the front end up. I think what's going to happen is this. I think they're going to go and taper. They're going to reduce their purchase of mortgages and of treasuries, that you should get a steeper curve from that, and they'll keep the front end pinned close to zero, and you'll get a steeper yield curve. This is a public policy good. And I wrote in detail about this in my open letter to the Fed. And the reason why it's a good thing, let's think about this. You get a steeper yield curve. That means that the underlying plumbing, the banks, are better. Because remember, banks, they lend long, they borrow short, steeper curve, profits go up. And are banks good guys? No, they're not. And should a lot of guys have gone to jail 10 years ago? Yes, it's a travesty that Obama did not put guys in jail the same way the first Bush did for the SNL crisis. But I can't fix that.
But we need the banks because we're a highly levered financial economy. Higher interest rates helps the insurance companies and the pension plans, right? Because they have to go, they price all their assets based upon taking money in today, paying it out in the future, earning interest over time. So that makes them stronger. It's good for healthcare. To the extent that rates go up, that will make long-term healthcare insurance policies cheaper because the insurance companies will earn a higher interest rate on the money they take in up front. And making it more affordable is good because that way fewer people may be on Medicare. Also, you enhance the retirement income of the boomers. Yes, the boomers are like locusts, and we've eaten all the goodies and destroyed life for my kids. And yes, I'm guilty of that. But I am a good locust, and I care about my kids. And so higher rates would go and let me earn more money on my savings, and that would come out of the pockets of corporations that borrow. Is that a bad thing? Not really. I think that if you can build a factory borrowing at 2%, you could probably build a factory borrowing at 4%. 8% different animal entirely. So, but most importantly is this: allowing the back end to find its natural level is the most important thing of all. The yield curve is the best predictor of a recession. Of everything we have out there, every tool available, the yield curve has the best record of predicting recessions, and we need that so people can risk manage. To the extent the Fed is controlling the yield curve, they are concealing information that the yield curve would offer, and that creates moral hazard. And that is exactly what happened in 06, 08, 09. Is the Fed concealed risk by saying we're going to go and do measured pace.
Right. When they kept just going up 25 basis points every meeting for what, 2 years, 3 years?
Something like that, man. And you go and do that, all of a sudden you can sell a lot of 6-week, 30 basis point out of the money puts, can't you?
Right. Because you know exactly what rates are going to be because he's told you.
Yep. That is bad. As a matter of fact, dots, I'm against dots.
Yeah.
I want uncertainty. It forces people to be risk averse and to control their investment process.
Okay. Sorry, go ahead.
That's it.
Okay, so listen, Harley, you're preaching to the converted here. So I'm going to push back on, and I'm going to push back in a respectful way that what someone else would say, not what I'm going to say, because I completely agree with you. I also think it's ridiculous when people say, "Oh, isn't the Fed going to peg the yield curve?" I go, why would they want to do that? You go look at when Japan did it, they have no more bond market. And the reality is that by pegging it, you lose all the signals that it could potentially give you. So I think that the U.S. will be the absolute last country to peg the long end of the curve. I know they've done it in the past, but I just don't see it happening. But here's my pushback to this idea that the Fed will, in essence, let things heat up to the point where the long end starts to really go up. A lot of people on Wall Street, they look at it and they see this, and then they see the inflation that is happening, or they see the speculation that is happening. And I'm kind of always shocked at how quickly they want the Fed to come in there and raise rates. And I'll give you a perfect example. If we remember back to 2017, Stanley Druckenmiller and Kevin Muir were writing all sorts of articles about how the Fed was risking all sorts of, let's say, exuberant speculation, inflation, and they were all against this, the Fed being so loose. And then what happened was when the Fed actually came and tightened, they quickly changed. And then next thing we know, they're doing during the Christmas massacre, they're writing op-eds saying the Fed needs to lower rates. So it always seems strange to me that Wall Street wants the Fed to tighten, and when they don't, they take stuff like gold and other commodities to excessive levels, and they would argue that the inflation that is created by the Fed being too loose is not worth the eventual pain that we're going to feel later. So what would you say to them?
Oh, God, there's a whole lot packed in there. I mean, I think we have to recognize that the Fed wants inflation. We have a debt crisis, and you get out of debt by default or inflation being a slow motion default. Fed wants that. So I think, and by the way, I think they're right.
Right. But I think that they want to make sure they want to be a little bit pregnant, though.
Yep.
Right. And isn't that the real problem, is that the moment it starts to look like they're actually being successful, they panic. And I would argue that this recent move by Powell is a sign that he didn't have the guts to go through with it. I think that this last Fed meeting was a rather market shift. And it seemed to me that he tapered quicker than he had to. Now, maybe you could argue that's a good thing because they shouldn't be there in the first place. But the dots moved up. Now, the dots are kind of useless. But it seems to me at the margin that the flexible average inflation targeting program that he extolled the virtues of has been kind of thrown out the window a little, because they're looking at inflation at 5.5 and they're a little nervous.
Well, I mean, they can legitimately say there's a base effect to inflation, because the prices did go down during COVID. So, I mean, if prices were 100, they went to 97 during COVID, and now they're 102. Well, yes, they have gone up 5 points year over year, but they're really only up 2 points over the course of time. So that's what base effect means, and that is true. So we're not going to know for realsies if it's, the real deal or transitory for another 6 months.
Okay.
But I mean, notwithstanding that, I think their hope, they want negative real rates, right?
Yeah, 100% agreed. Yep.
So really, the trade here for the Fed is, can they get higher rates slowly?
Okay.
As opposed to quickly.
So I agree with that analysis, and that's what they're worried about. They're worried about it. And do you see that is a risk that rates all of a sudden go from the 10-year 1.5 to 2.5 in a hurry?
I don't think so.
Okay, why not?
I think that there's enough people out there. You have insurance companies and banks who will be buyers of interest rate product. If you can get rates up a point and still have stocks here, you'll have pension funds that will sell stocks, buy bonds, and lock in their asset liability mix and call it a day. They're still underfunded. But if you can get rates up a little bit and still have stocks here, these guys have been underfunded for 20, 30 years now. If they can get back to parity, God bless them, man. They're going to do it.
They're going to. So why don't you explain to people what that means, and explain why that would occur?
What happens is that, let's say a pension fund knows they're going to owe someone, $100 when they retire in 30 years. And they've taken in money from them over the course of time, and they've taken in $50, let's say. And they figure that they can go and make, X percent for the next 30 years. And that 50 will go to 100. And when the person retires, all's good. In fact, maybe it goes to 105 and they make a 5-point profit. What happens if instead of investing money at 5%, they're investing money at 3%? Well, now that $50 will only go to 80, and they're not going to be able to cover the money they owe. And that's called being underfunded. So people do calculations. That's why you have actuaries and accountants to try to figure out, given current interest rates and everything else, current death rates, accident rates, fires happening, how much money we got, how much we're going to earn, how much we're going to owe. And they balance out what that is. And since rates have gone down by so much, they cannot make enough money and they're underfunded. But their stock portfolios went up by much more than they thought. So now they're kind of close. You'll hear the real propeller heads talk about state and local pension funds. The federal pension fund is Social Security, but they just print the money, so it doesn't matter. States and local governments can't print their own money. And most of these state and local pension funds, your local fire department, teachers union, whatever it might be, they're assuming that they're going to go and earn 6.5%, 7% still, which strikes me as being not likely, seeing as junk bonds yield 4%. And so they're underfunded, and that's what people are kind of waving their arms about, is what's going to happen when these boomers retire in the next 5, 10, 15 years. Rates going higher solves that problem for them. So they will buy bonds because it reduces that gap, that underfundedness in their problem.
So inherent in your analysis is the idea that if we get a situation where rates backed up that quickly, there would be a shift out of stocks into bonds.
Yes.
And so I guess where what surprises me is that you think it would occur so quickly. So you think there's an underlying bid to the bond market that's at a lower level, meaning higher rates, is quicker than I would have imagined.
I think there's a bid there, especially from foreigners. I mean, you still have negative rates in Europe and Japan,
right?
So it's going to be hard to really have rates jump a lot quickly. Can they go up with higher inflation? Yes, especially if we get higher U.S. inflation than European inflation. What you'll see, this is now really dirty business, is foreign exchange rates are driven not by the underlying single rate, but by the real purchasing power of these cross currency assets. And if U.S. inflation goes up by a lot, people will go and they'll sell dollar bonds, buy European dollar bonds, and maybe they'll make less money, but they'll make it back by the exchange rate moving by more than the interest rate differential. And so all these things going on, we're in a global world, a global market, and people got to look at all those things. So I think rates are going to go higher. I don't think it's going to be a runaway train.
Okay.
But I'll say this is most important, that if we do get rates up reasonably higher, that your big FANG stocks are going to be in a real pickle. Because those FANG stocks are basically 70-year duration bonds. They're very long-term bonds. And if rates go up, those things are going to hit a headwind.
And do you think those are overowned?
Overowned? No,
meaning that clients have purchased, like the endowments, the pension funds, that they've bought too much of those names because they were the things that were working best.
You were right until the very end. It's not because they were working best. It's because so much money is going into passive index investing.
Okay.
As these stocks get bigger, they become a bigger proportion of the index, and therefore you have to buy more of them. So you get this kind of circular, virtuous cycle, I suppose, where as these big stocks get bigger, you have to buy more of them, and that drives them even higher. So I do think that passive investing has been a significant driver of the FANG stocks.
Okay. So we're getting towards the end. I'm trying to think of some different questions because you've been on the show before, and I'm just going to spring them. I should have actually warned you about them, but I was thinking about who was the analyst? Was it Barton Biggs that used to talk about his potential surprises that the market is underestimating the possibility of? I think it was Barton Biggs. And I was wondering if you have one, and if we think back to what he used to say something like the market only gives a 1 in 10 chance of this happening, and I think it's closer to 50-50. Do you have anything that, like, if you were to think about something the market is potentially under appreciating the possibility of occurring, would you have anything that jumped out at you?
The only thing that's obvious to me is that people think that the Fed, the central banks, can control everything relatively easily, and that today's risk profile is tomorrow's risk profile. They certainly have overvalued the so-called Fed put.
Okay.
And the Fed will try and use that put, but it's unclear they can maintain that. I think the surprise has got to be if we actually get real inflation, like not 2-3, but 3-4, for like a while. Do I predict that? I'm not sure, but the market certainly has not priced in a 4 or 5% inflation number at all, because if you get that, lots of things happen that are not good in terms of the yield curve, in terms of volatility, most importantly in terms of the correlation of stocks to bonds. This whole notion that stocks and bonds hedge each other totally falls apart if rates go above 4%.
No, so you think that's a function of an absolute rate as opposed to the type of environment? Because I've heard other arguments that in an inflationary environment, bonds and stocks have traditionally been positively correlated, and in a disinflationary environment, they've been negatively correlated.
When you say positive and negative, it depends if you're talking about stocks to rates or stocks to bonds, price to price. I mean, you're using prices together, which is true. So they've been negatively correlated for the last 20 years.
That's correct. Yeah.
Okay. And what I'm saying is if rates went above 4, they would go in unison, which would be bad for a levered portfolio.
So you think it's just the absolute level of rates that matter that would change that correlation?
All evidence is that's the case.
Okay.
But
I guess, what, to be fair, in a type of environment, an inflationary environment, we kind of are almost both right, because chances are the long end will be more than 4 in a real inflationary environment.
Stocks benefit initially by inflation because their earnings go up nominally because they're charging higher prices. The problem is, as you increase rates and increase inflation, it becomes bad for stocks because now the PE has to go down to maintain parity with bonds. And so that's there's kind of like initially inflation is very good for stocks. So I would not say I'm bearish on stocks right now because I think this initial inflation is good for them. And the government's going to print money. So
Right.
that's good for stocks also.
But just as a little caveat aside, back to your idea about those 70-year tech stocks or 70-year bonds that you call tech stocks, in a rising rate environment, you don't want to own duration, and that's what would be the biggest duration. And I guess on the other side, the shortest duration would be the type of more value stocks.
Yeah, agreed. I mean, the expression we use is power windows down. Is what would happen with if we get higher rates in the tech stocks.
Power windows down?
If that's the expression.
What does it mean? Explain to me. I'm sorry, I don't understand that.
They go down fast.
Okay, I like that. Okay, last question for you. I know you're a big traveler, and I traveled across Canada this summer in an RV. And when we were chatting, you said, "How long are you going for?" And I told you a month, and you told me I was insane. But in the past, you've been you've openly shared a lot of your trips. You have it up on your website. I would just love to know what were maybe one or two of the highlights of all the different trips that you've taken with your family, like the ones that you would say, this is a can't miss that everyone should try to do with their family.
Well, it depends upon how aggressive you are. I mean, we did 5 different RV trips. And if you have young kids, like, under 12, an RV trip, I would highly recommend that. It's extraordinarily affordable, and it gets you out of your zone and with the family. You can rent these things from El Monte RV or Cruise America. First trip, go fly to Flagstaff, rent there, and then you go up left, you hit Glen Canyon, turn right, Zion, Bryce, Capitol Reef, zip back down again, go through the Navajo Reservation. Do that in a week, and you're in good shape.
Okay.
So,
okay, and then give me one if you're on the fancier budget, the Wall Street budget, and you're traveling and you can fly anywhere around the world. You've been a lot of different places. What's been the highlight there?
Laos and Burma.
Oh,
very interesting. The Laos it's all French cuisine, and it's very interesting there. A lot of interesting art and everything else. In Burma, just to go, and I mean, most of the authoritarian communist world has bled over to the West. Burma is still it's still the old country, and it's an authoritarian regime there. It's very interesting being in that place in terms of the economy, but in terms of the politics, in terms of everything. I mean, if you want to get a look of what it was like to be in the Cold War, in a place that could change an awful lot in the next 10 years, this is it. We never took our kids to France or England. Like, those places ain't changing ever. We always went to places that were going to be different in 10 years.
That's fascinating. Okay, so before we go, why don't you give everyone one last kind of peek about where they can find more information about you and your firm?
Simplify Asset Management, simplify.us is our firm. All of our stuff is there. My website with all my commentaries is convexitymaven.com. If you want to get added to my list, it's free. Just ping me at harley@bassman.net. And finally, if you do care about interesting vacations, go to bassman.net. I have many of our family trips there, along with the itineraries posted at the bottom, so you could try to recreate them if you like.
Harley, it's always a pleasure, and I really highly recommend that people take you up on your offer and get on your letter. It's always a wonderful read, and I know I always learn something, and best of all, it's free. Anyways, thanks again for your time, Harley.
Thank you very much. Have a good day.
Okay, Patrick, it's time for Talking Charts. What do the Magic Crayolists say this week?
All right, well, let's review the top 3 things to watch. We'll start with what we were watching last week. And so we were watching oil and OPEC. And last week we saw some substantial volatility in crude oil. We saw that dip down on crude that basically had us hit almost $75, but then boom, it just rips right back up to the highs. Incredible volatility on an intraday basis that we have seen, but it really does look like crude is staying in that bull trend for now, right?
It's getting spicy. It's getting spicy. Some good trading there. Lots of opportunities. It is all over the map. And, even though we talked about crude, if you looked at some of the nat gas, and especially nat gas over in Europe, just unbelievable. Mm-hmm. Just crazy stuff happening there.
So number 2 was we wanted to touch on that Russell NASDAQ rotation and whether that would continue. Nothing really crazy changed this week. Like this is that Russell NASDAQ chart, and was actually everything really calmed down this week when that market did a little bit of a bounce. So it's too premature to suggest anything other than the trend that's been in place at least for the last month or so.
I will tell you this, though, Patrick. I was running on my Bloomberg. I was running the factors, and you can look at what factors were the best performing for the past week, and the number 1 was value. So it's occurring. It's happening. It might be under the covers, and it's not something that jumps out at you, but it is occurring.
Yeah. And the number 1 was the jobs numbers.
Yeah. Oh.
Well, we're going to settle that in the bet. But
so let's not talk about it. We'll talk about it at the bet.
Yeah. So listen, this week, the top 3 things to watch. The first thing I wanted to touch on was China. And so I want to just pull up the chart. But we really have seen in the China A50, here we go. The China A50 has been more or less selling off since February. And but we've since the middle of the summer, in late July, saw an extended consolidation in the Chinese stock market, stopped making lower lows, started to turn up, and just this week we're seeing these breakouts on the upside. And what's particularly interesting is that when we look at, I'm just going to use Rob Koifman's Koifman platform. This is a great platform for showing this. You see, this is the Crane Shares Trust, which is for the China Internet ETF. And it retested the lows and had this little reversal on the upside. It's really interesting to see. Now, China in general has been in a pretty substantial downtrend for an extended period of time. 1-2 days is not enough information to say that the prevailing downtrend is over. But this is the first time in a while that we've seen this space come to life. And when I go here to the lots of charts feature of Koifman, you can see we can just look up actually the holdings of that China Internet ETF, and we can look at all of the charts on here. What's interesting is whether you're talking about Tencent or whether you're talking about JD. There's all sorts of these stocks that really have started to stop making lower lows, started to turn up. Is this a bottom?
I think this is a great thing for you to put in the top 3 to watch next week, because I feel like few people are talking about it. Everyone's focused on something else, and then this quietly looks like it might be hitting the point where it's no longer going down and perking its nose up. It would be just like the market gods to have these things rally just as everyone's given up on them and everyone thinks that they're dead in the water.
They were left for dead, Alibaba and all of those names have been, Baidu, like they're all just been hammered. and finally they're starting to see some life. And I think that that's certainly something I want to watch next week. Number two, we have the option expiration and going into next Friday, the monthly OPEX, as well as the market volatility that we have seen. The question is, are we going to see the markets, now that we're more or less around this 4,400 level on the S&P, are we going to see this more gamma pin up here into the Friday close? I still think there's lots of volatility coming for the rest of October, but will OPEX leave it as a quieter week, or will the gamma kick in and we see that it actually creates an extraordinary move? Do you have an intuition on that?
Well, I think that we're back at the situation where the dealers are long some gamma again. Now that we got through what they thought was going to be the FOMC, what the FOMC, and then also the debt ceiling problems, and now the dealers are long gamma. And you would think that would mean that we would see a return to the old grind higher as we go into expiry. But Patrick, like today, I think is a great example. There was tons of charm, which is the amount of buying the dealers need to do going into the close based upon a change in time. And there's tons of charm that should have happened this weekend, and yet we kind of went off on the lows. And you could see there was an attempt at a rally, and it sold off towards the end of the day. One of the things that I always counsel people about when you're looking at those options, the positioning and the dealer positioning, and when there's nothing else happening and they are the biggest force, it's really important to pay attention. When there's a fundamental change that is occurring, they can be overpowered. So don't be careful when you're reading those things, that you don't assume that they are the only force in the markets. Well, and because I think that a lot of people do. And for example, today there should have been a lot of charm. There should have been a lot of buying, and we had it going into the close, and then all of a sudden it got run over and it got overwhelmed.
And so, but what's also interesting is that whether you're looking at the S&P 500, well, I'm just using the SPY here just to show this recent rally, or whether you look at the Qs, the interesting thing here is that both of these charts, while we've had this 1-2 day rally, we haven't really turned the trend. And if we come in next week with no motivated buyers ready to take this higher, the selling the rips is the natural tendency during a correction, and if there's no follow through, it could very quickly turn into selling all over again early next week.
I think until we're proven differently, I think it's sell the rips as opposed to buy the dips.
Yeah, and so number one, we got to watch that inflation number next week, right?
Oh, well, Patrick, it's all this on everyone's lips in terms of talking about inflation.
That's exactly it, right? Like, and it's not even whether a monthly print on inflation is important. It's just everyone cares about it so much. It's like it's on everyone's mind, and I think that there's a psychological element to it. And I think everyone's going to be glued to their screens next week to see whether or not we see that inflation just keeps sustaining at higher levels, or whether the rate of change has shifted and whether it starts to turn over.
So here I have a question for you. If all of a sudden we had an inflation number that was way less than expected, what would you do? And the reason I ask is because I said to people with the unemployment number, I was like, I don't even know if you told me the unemployment number in advance, I'd know what to do with the Friday's unemployment number, today's unemployment number.
I don't necessarily trade a data point like that per se, so I don't think I'm going to be reacting on the number from a trading perspective. But
if I forced you to do it, if I told you that number, what would you do? And I don't know. Obviously, it was a huge number to the upside and inflation spiked, then it would be easy. You go and you sell bonds. But I'm not even sure if it ends up being that inflation comes in a little light, that the bond market rallies. And does the stock market rally on that too? I don't know. It could be. Could be that easy, but I just don't know. But there's definitely a lot of people looking at it, and it would just be like the market gods to have a crappy unemployment number,
I think
crappy
the
inflation number.
The easier thing to do, as always, is let the first reaction, miss the first reaction, and see if it establishes a new trend, and jump onto the coattails and go for a ride. You might be getting in the second inning of the game, but rather than playing this guessing game and positioning yourself before the number, it might be better to just be a little bit late to the party and have certainty as to which way they're taking it. Right.
I'm glad that you're here, Dad, to tell me those things. Okay, what do we got?
All right, let's look at some other charts here. I'm just first of all, I wanted to just highlight just how weak the euro has really been, and it really continues to break down to lower lows, and it continues to be in trend. It's really hard for anyone to make an argument that the U.S. dollar is imminently going to start breaking down until this chart starts doing something progressive. Like this is outright distribution. It's almost accelerating to the downside, and it doesn't seem like there's an end in sight. I think we could see 114, 113, even 112 on the downside during this impulse. We'll see how far this goes. What's your take on the euro?
Oh, I think it's interesting because at a certain point, this is going to be detrimental to U.S. risk assets, meaning that as the dollar goes up, and especially against Europe, if you're a car company competing against the BMW or all these different car companies, the fact that the euro is becoming cheaper and cheaper, it just means that they're going to steal growth.
Yeah,
and it'll be interesting to see what happens. I don't really have a real opinion, but I do think it's interesting that very few people are talking about it. Yeah. And I always like those stories, Patrick. I like stories where it seems to be that a move's happening and nobody's focusing on it. Everyone's focusing on something else.
You know what's interesting as well? I'm curious whether or not we're seeing a turn in some of the precious metals. Now, obviously, gold and silver is on everyone's mind, but like if you even take a look at the way that we've seen the turn here on palladium. It really didn't make a lower low, breaking trend lines on the upside. It really seems like it's turning back up, and palladium is off of its lowest levels. I mean, you generally are seeing some of these precious metals turning. It'd be really interesting because the precious metals market in general has just been the dog, right?
It's been a terrible, terrible sector. And just as a little aside, I've been telling people that if you were thinking about tax loss selling, that's the sector to be picking away at it. Go and look at some of the miners that people are going to be selling. There's very few stocks that are going to be so bad as those.
Yeah.
Right. So all I can say is, Patrick, is you highlighting this and saying that we might have turned from your lips to God's ears.
And so, well, you know what? The other one I wanted to look at is the rare earths, the not so rare rare earths.
Yeah, you love this one. You're like the only guy that trades this. They keep this ETF alive for you.
You know what? I guess the fact that it's up a couple 100% on a year is clearly it's just me that's paying attention. Clearly, it's just because you and your little chat room buddies haven't touched it. It doesn't mean other people haven't. Anyway, so I'm not going to get triggered by you. Let's what you can see though is that it's been pulling back during the last several weeks, rightfully so, correcting. But one of the interesting things that we're going to be watching is as it approaches some of these Fibonacci zones and approaches what were its previous highs, it'll be really interesting to see whether this also gets bought on dip here. And that's something that's definitely on my mind as we're going to be going forward. The other interesting thing I wanted to just touch on was some of these fangs, right? Like if you first of all, ARC continues to be very weak, right?
Oh, don't you go to my short.
Okay, I'm not going to say anything else. I'm shorted too, so I'm not. Okay,
listen,
let's change the topic.
You guys should buy it.
Yeah, buy it. Yeah, exactly.
Patrick and I are both short.
Crazy Kathy. She's probably anyway. Okay, I'm not going to say anything else. So, but what I wanted to just highlight. Okay, obviously Facebook took it with that outage, took it on the chin pretty hard on the downside. But these FANG stocks continue to look very weak. That rotation continues to be dominant, but I find it very hard to believe that the correction is over if the FANGs don't at least find a bottom. And this chart, like for instance on Facebook, or let's even take a peek at some of the other ones like Amazon, right? Like Amazon, well, fine, it bounced a little bit, but it's holding right along its previous lows. Apple couldn't even muster a meaningful bounce off of that bottom. This is only one that looks half decent is Microsoft, and Netflix is like Microsoft at least is approaching its trade range from above, and Netflix is held up very well. But overall, these FANG stocks are still very weak. And they're such market cap behemoths. I don't know how the indices can suddenly start bulling higher without these first establishing a bottom. They don't have to be the leadership on the way out, but they have to stop selling. And I just it doesn't look like they're done.
Again, from your lips, we shouldn't go through it. What else you got for us?
Tesla.
Well, although I have to say, we were both right that we said if you didn't, what was our line? I said if you didn't know the chart, if you didn't know what this company did, if you didn't know it, you'd have to buy this chart, and it continues to do well.
Unbelievable. But the thing is that between the selling pressure and as there's Kathy's assets under management are shrinking, she's got to be doing some selling at Tesla, and she can't just be dumping Nintendo only. And so the thing is that there's got to be selling pressure from there. There's got to be selling pressure from the Nasdaq underperformance, and yet Elon Musk. He just seems like I don't know how they can keep the stock up like this.
So the only thing I will say, Patrick, is that I have noticed, and I've spoken to some kind of outspoken Tesla shorts, and they literally have given up. They just someone said the other day, like, it's just fighting this has just cost me too much in terms of my well-being monetarily. Like they've won.
Tell me when they've capitulated. So
I think they've won. They've given up. I don't feel like I feel like Mark Spiegel will be the only guy that's still short this thing. Honest to God, Mark will be the only one. Mark is like they're gonna like he's doing a Clint Eastwood. They're gonna pull Charleston Heston. They're gonna pull they're gonna put the buy ticket through out of his cold dead hands. I'm sure he's smart. He'd like that. But no, I do think it's interesting, Patrick, that a lot of them have given up, and I just people are like, I don't understand it. I don't get it, and I just don't care anymore. And I've noticed that it was more than one have said that to me. And listen, the chart's unbelievable. And the only thing I will counsel is that maybe we're wrong. Maybe Elon is a business genius and this stock is dirt cheap, just like Kathy says, and we're headed a lot higher. Listen, good trader never says never. Having said that, I'm pretty sure Viacom and Discovery looked really good as well until that moment when something went wrong.
Yeah.
Right? Can you pull that up quickly?
Yeah.
Like if I gave you Viacom and you looked at that chart and you were just looking at the chart. Here we go. It's coming up. I guess it looks like crap now. But having said that, before the big spike on the way up, it looked technically great. Right?
Well, an uptrend.
But my point is that it was going straight up. It went straight up for how long?
When you're gamma jamming it to the upside.
But that's my point. Is that and you know what? I know this is talking charts. Charts sometimes lie.
No, the price did go there.
I guess that's true.
Just buying higher highs is not always asymmetric.
Anyway, it's a great looking chart. Everyone is at home or that's doing it. Make sure you look at Viacom and just think about that.
The last thing I wanted to look at, look at that reversal in lumber off of this low.
You got to own it. Dirt cheap. It's only what is that? $600?
I actually, I'm a seller on the idea that this thing is going anywhere near those previous highs.
Well, how do you find anywhere near?
I am a seller on the idea that lumber is going to go back above 1,000. Now, if you want to clip $100, it can easily go from 720 here to like 850 or 900. But the idea that we're going back to 1,700, I'm a huge seller on that.
Well, yeah, but the 1,700 that was just stupid.
Look, from 500 back to 800-900, fine, that was a great.
But you're
double.
like talking about $200 on 700.
No, I'm saying like there's a double off of 500, right? Like 500 to 900 is someone who bought.
It's only in this market that we talk about. Oh, it's only a double.
All right,
it's not like these other things that can really explode.
All right. Anyway, that's all I got, Kev.
Sounds good. Okay, so let's go on. This week in trading history. What story do you have in store?
All right. Well, we have two things we're going to talk about. First of all, I want to go for it was October 8th of 2008 was the acquisition of Wachovia by Wells Fargo. So Wachovia was a financial holding company, which at the end of the second quarter of 2008 had assets of $812 billion, making it the fourth largest banking organization in the United States in asset terms. Now, Wachovia had been profitable continuously for more than a decade through the end of 2007, but during the first half of 2008, Wachovia posted losses totaling $9.6 billion, reflecting drawdowns on securities and high provisions for loan losses. In part, the provisions reflected significant expected losses in those ARMs, the adjusted rate mortgages, and also reflected declines in the value of commercial real estate mortgages. The troubles at Wachovia, though, occurred during the period of extreme financial distress. It was September 25th of 2008 when the FDIC seized and sold Washington Mutual Bank, then the largest thrift in the United States. The day after the failure, Wachovia bank depositors accelerated the withdrawal of significant amounts from their accounts. It was a run on the banks, right? And that's always a problem, and that's really one of the crazy parts of that crisis, right? Nonetheless, in addition, wholesale fund providers withdrew liquidity support for Wachovia. It appeared likely that Wachovia would soon become unable to fund its operations. That week, Wachovia management, which had engaged in tentative discussions with potential merger partners earlier in the month, began discussions in earnest to sell the company. On September 27th and 28th, both Citigroup and Wells Fargo, the second and fifth largest bank organization in the United States, respectively, conducted due diligence investigations on Wachovia. On September 29th, Citi proposed to acquire most of Wachovia's assets and liabilities, including Wachovia Bank. But it was on October 2nd, 3 days later, during a period when Citi and Wachovia were negotiating the final merger agreement, that the board of directors received a communication from Wells Fargo that included an offer to acquire all of Wachovia's stock by merger in an all-stock deal that would value Wachovia at $7 a share. That was crazy because, like, I think I don't know the exact number, but Wachovia was down to just a few dollars a share. So $7 was double or triple off the worst levels. Nonetheless, in the same day, President Bush signed that TARP bill into law, that the $700 billion bill provided an infusion of capital into the troubled banking system by purchasing all those subprime mortgages from the banks. Nonetheless, that happened back in October 8th, 2008. I have one more story, but do you have any comment on that? Do you remember?
It's interesting you talk about the TARP bill because I had written about that recently. I don't know if you remember, Patrick, but that TARP bill failed the first time it went to the Congress. And it when we had a situation when that failed, I still remember it because everyone was sitting around watching the vote. And we thought, oh, it's going to be, they took it down. They took it down to the floor for a vote. It must be, it's going to pass. Like, what kind of idiot brings it down for a vote if it's not going to pass? And then we were sitting there watching the numbers go through. And you got that kind of grainy, C-SPAN screen or whatever it is that you're looking at. And they have the white lettering and you're looking at it, you're trying to understand it. And all of a sudden it looks like, holy shit, like what's going on? Are they waiting to all the yeses to vote at the last minute? And it's not going through. And then we get to the end and it looks like the nays have won. And the CNBC guys are saying, no, don't worry. They can strong arm guys and change their votes until the gavel goes down. And I still remember this. Everyone's sitting around saying, no, like, what? Like, they can change votes? And then they go, okay, they're going to change votes. And then all of a sudden, boom, the gavel goes down and somebody leaned on the sell button on the S&P like I've never seen. It went straight down 8%.
Yeah.
It was just boom. It was unbelievable. And the lesson in that is never underestimate the idiocracy of politicians.
There you go. So I had to though do one more little hit for this week because it doesn't make a good story for a bigger thing, but I thought it was interesting. It was 10 years earlier of it was October 7th, not 8th, of 1998. This week in history, when Jim Cramer declares that a bear market has arrived. And so he goes on record for saying, this market stinks to high heaven. The NASDAQ is deeply wounded. Nothing lifts it. All moves up seem phony. It has the feeling of ugliness led by Cisco that says, you can't hide here.
You know what's amazing about that is that was before the really crazy moments in the .com bubble. That was, I guess, in the midst of.
I was about to say it was one day later that the NASDAQ bottomed out, and then over the next year it gained 48%, 49%.
Yeah, so he missed it, but then the best part about it is how bullish he got at the top.
Yeah,
because if you remember, he wrote that song. He didn't write a song. He wrote that. They made that speech about 7 stocks for the new millennium, and they were the worst. Like I think 6 of them are bankrupt by now, and he was so bullish. So he's falling all over himself, bearish at the lows, and puking out all of his lungs at the lows, and then grabbing everything he can at the highs. It just goes to show you markets make opinions and not the other way around.
Well, it's nice to know that me and you are not the only fools that try to call tops and bottoms of markets. And
well, I hope I don't do it as badly as he did it.
Exactly. Yeah. All right, that's all I got, bud. Let's go on.
Okay,
right.
Patrick, it's time for skin in the game.
I gotcha.
You did. Well done. Well,
it's so just for our listeners, we were betting on that non-farm payrolls, and you gave an over/under at 410, and
I knew enough. I sent it lower, trying to entice you to the top side. Now, I just want to say that, Patrick, you're going to make a bond trader yet because you're basically celebrating economic weakness. See, that's the funny thing about bond traders.
I'm celebrating the burger that I got. That's
okay. But the reality is that the unemployment number was under expectations, and Patrick's like, yeah, which is the same as like a legion of bond traders. If you think about it, they sit around and they're happy when everything's going to shit. They're a morose bunch.
I'm not happy.
I know you're just happy on the burger.
Yeah.
Yes, you won by a long shot. It was a terrible number. Even though I had kind of tried to skew it, you were smart enough to take the down. You did well, and you win yourself a burger. Let me tell everyone about this game. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerates. We are degenerate gamblers. We are degenerates too at heart. Every week, one of us presents a wager. The other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode. And the currency is as follows: a Duke and Duke, a pint of beer, a burger bet, a pitcher, case of beer, a bottle of wine, and a steak dinner. The winner of the bet is obligated to create a new bet for the following week. So that's you, Patrick. And all wagers settle in full, and there will be no netting of positions. Okay, so what do you have?
Well, you know what? one of the strongest currencies out there. Well, the U.S. dollar. So one of the weakest currencies has been the yen, as the U.S. dollar is running.
Bugger, you knew I liked that yen. Okay.
Yeah, and so one touch, 113.25 by next Friday. You know what? We don't have an episode next, but we can still settle it the week after.
That's right. We can settle it. We can do it for next Friday.
Or maybe I should raise it and we can make it a 2-week-long bet.
Up to you. You decide.
No. 1 week. It's next week Friday. One touch, 113.25.
Come on, are you serious? Because that's okay. I'm taking the touch.
You're taking the touch.
Yeah, that's not enough.
There you go. All right.
I'm taking the touch.
Well, you know what?
I know you wanted me not to take the touch, but I'm taking the touch.
All right. No, I'm okay with that. It's you know what? Based on its vol, it would be a little bit more than a one standard deviation move for a week. So let's see. You got the tailwind of the momentum, and it certainly measures up to there. So you could very well win. But I am happy to take the other side of your bet. So let's throw something down here. A case of beer.
Oh, for sure. Done.
All right.
Okay, you're done.
Okay. All right.
Time for that next one, which is no stupid questions. Only stupid answers.
Which I'm more than happy to provide.
And I'm so happy that everybody responded. We had lots of questions this week.
Yes, thank you so much. We all of a sudden. And now, you know what? While we're at it, we need to make a shout out and ask people to send us some more symptoms.
Yes.
Side effects. I guess that's what we call them.
Yes.
Anyways, Lynn, give us the first question.
Hey guys, I grew up playing hockey in the South. I know, weird. And was always told using the term hoser was an insult. Is this true? What does it mean? Also,
okay. All right. Well, let's stop.
First?
Yeah, we'll stop.
Yeah, we got to stop there.
Hoser is essentially something like calling someone like a hillbilly or something. It's
it's kind of also like an insult, like you idiot, you hoser.
Yeah.
Like you can use it, and it is kind of an insult, but at the same time, it's a term of endearment as well. You hoser.
Well, the dictionary says a foolish or uncultivated person.
Yeah. So but I don't know. But if you called me a hoser, I'd like it. You'd be like, yeah, I'm a hoser.
All right, Lena, let's go on.
Okay, so also I'm a small retail investor who has been bullish oil and energy for several months now. Initially, I bought GSG as part of my play since it is heavily weighted in energy after listening to Cuppy and Pinecombe Macro pound the table for the last month regarding oil. I've been looking to rotate more into a pure oil play. I don't have access to futures, and the prospect of having to take physical delivery scares me. So I've looked into USO and OILK. Why do both of their prospectuses say their goal isn't to exactly track the price of oil when broadly their purpose is to track the price of oil? Oh, that was like a tongue twister for me. Also, if USO is supposed to track oil, why was its per share value $800 plus back in 2008? As always, thanks.
All right,
that's a great question. You want me to go, Patrick?
Yeah, but let's start off with looking at the chart. So he's referencing here. This is the USO, and he's referencing back in 2008. This peak on this chart is showing like $950, right? And,
right.
And so anyway, I'll let you go ahead and explain.
So USO technically does not buy oil. USO buys futures, and futures trade with a carry, and often the carry in oil is negative, meaning that you buy the front month and it trades at a higher price than the far month. So as you go down in time, it actually decays, meaning that it will go down. So even if oil doesn't go anywhere, you're buying a contract that is decaying in price, so therefore you lose. Now, having said that, the shape of the curve varies, and it's difficult to trade. It's difficult to take advantage of that unless you're trading the futures. And one of the things that Cuppy is highlighting is the fact that the curve right now is inverted, meaning that the front month trades at a much, much higher price than the far dated months. So when Cuppy goes out and buys December 23 or December 25 contracts, he's actually paying a lot less than what people are paying in the spot market currently. Now, if nothing were to change and oil were to just be flat, he would earn that positive carry. The reason that the USO has done so badly is because it's been the opposite. It's actually had negative carry. Yep. And this is one of the problems with trading an ETF where you can't take advantage of different shapes of the curve. And it's one of the advantages that guys like Cuppy have by going out and actually trading the futures contracts. Now, so that's why it's done so badly. Another example of this is if you go look at, for example, the VXX. UNG is another one, but there are a lot of them. VXX is another one, which is the volatility index. And if you pulled up the VIX over a period of many years, you'll see that at any one point it might be down 10 or 20% from the previous year or two. But if you were long if you were long VXX, you would find that your loss would be dramatically higher than that other change. And that, again, is because of the large cost of the carry.
Yeah, so here's an example of VXX where, going back just a couple of years, I wanted to remove the coronavirus thing, but let's say the VIX dropped about 45% off of its highs, but you can see the VXX is down 83%. And that's because the contango in the curve, they're rolling that future out, and you're paying the tax to carry it every single month.
Right, it's not actually tax, but it's
the equivalent of it.
Yeah. Okay. So that's why it doesn't track, and that's why the right there in the prospectus of the USO it tells you that it's not going to track. And in terms of your other alternatives, it's difficult. There's no way to do it apart from like what Cuppy is suggesting in terms of going out and buying far dated contracts. There's no way apart from actually going and buying those contracts.
Yeah.
And one of the things that you might want to think about is if you're trying to buy the longest dated kind of exposure to oil, you can choose different companies based upon what you believe will happen and what you think the future expectation of oil will look like. But that ends up being complicated. And even Cuppy, we had him on the show, and he said, I don't bother with the companies because the trouble with the companies is the management will lie to me, or that there'll be a fire, or there'll be something else. And he says a million things could go wrong, whereas I just want to bet on the price of oil. And so he wants to bet on the price of oil. He wants to take advantage of the curve, the fact that it's so cheap way out the curve. And unfortunately, there's no other way to do that except for to open yourself up at a futures account and trade it that way. The only thing I will say is if you go and you do it his way as well, in that you traded options, you can do it where you can buy an option and then you will be limiting the amount of loss that you do. His favorite trade is that 90 to 100 call spread for 2023. So that call spread, he goes out and he pays, I don't know, let's say $1. He pays $1 for that call spread. If it expires through the upper end of the call spread, he's going to make $9 because it's going to be worth $10, but he only paid one for it. And that's how he's playing it. So you can still limit your loss, and you can do it through options on futures. Right. But it is a little more sophisticated, and I wish I could help you more. But that's probably the best.
The second question here that Lena's about to read is also a continuation of this. So let's quickly get the second question that we'll continue to have this conversation.
Hello from Minnesota, eh? That's exactly how this listener wrote it. Hey. I love this show and all the great guests, especially Cuppy. Do you have a recommendation for how to implement Cuppy's longer-term trade on oil as someone who does not trade futures? And if the producers and refiners are not going to enjoy the same 15-bagger upside, what else does that leave us to trade? Have done leaps earlier this year with success. Thank you.
So, Kev.
So can I just jump in here? Because one of the ideas that you might have is you might say to yourself, okay, well, Cuppy's trading 2023 futures contracts, and he's trading calls on that. If I go and trade leaps on USO, am I achieving the same exposure as Cuppy? And the answer is no. And the reason the answer is no is because Cuppy is trading a contract that is
much cheaper,
established out into the future. Whereas when you're trading the USO with an option, USO rolls every month. So it's a series of rolls.
But you're also getting the average spot, like you're getting the front month price, which is much higher. But this listener is specifically referencing the idea of producers and refiners, and referencing the fact that you can play the energy companies. The one thing I want to emphasize is that when Cuppy says 15 baggers on the upside, it's not like oil's going 15 bagger. His options trade is going to go 15 bagger.
Right.
And this is the thing is that, and this is where I want to respectfully say that I don't necessarily have the same view as Cuppy, because I still think that if oil is ripping that way, the majority of people that want to participate will take the oil companies to ridiculous levels, no different than tech companies with no earnings go to ridiculous levels. I'm a seller on the idea that fundamentals will matter if oil's ripping.
Well, I'll take the other side a little bit on that, Patrick, because I would argue that given the new ESG constraints, that oil stocks are going to continually trade cheaper than would otherwise be the case, because the pool of investment.
Where I'll disagree with you is the fact that I think that once oil starts actually hitting people's pockets and the politicians are risking losing voters because of that, you're going to see them take their foot off the pedal on those restraints very quickly.
But they're not going to take their foot off. You think that they're going to allow investments? You think people...
Well, if oil is ripping to the upside and inflation is running hot like crazy and they're getting, of course they're going to.
Yeah, I take the other side of that. They're not going to change. These policies that are put in place take years to do. When you have sovereign wealth funds divesting themselves of all their energy assets,
but it's not actually about. It's not about how long it takes. It's about the market smelling that they're going to do that. It's the perception.
So I agree with you, Patrick, that there will be new buyers that will come in as oil goes up. So I'm 100% agreeing with you there. There will be more and more retail. There will be more people attracted to it. So I won't disagree. What I'm saying is different.
If oil goes to $100, $120 a barrel, the XOP is going to go to $150 to $170, and someone who's buying a bull call spread on the upper boundaries of that can make 10 a bagger or 15 bagger just as easily as Cuppy is. I think that you can trade it in the equities. It's not that
I'm going to be. That's okay. That's what makes a market. I'm more in Cuppy's camp.
That's fine.
I think that the stocks.
Camp. I'm just saying that the stocks it's not the only trade.
Okay, I completely agree with you there. I just think that on the whole, the stocks are going to underperform, and that they're going to be forced. It'll be companies buying back their own stock, because the reality is they'll be making lots of money, but the market will pay less and less for them, because big institutions will not be willing to pay for that.
All right.
Anyways, that's what makes the market.
Let's agree. Yeah, we'll agree to disagree. So, Lena, next.
So, next question. This year has shown us if even fundamentally sound short positions can become toxic if, quote unquote, crowded with a big short interest. Although it's been a while, I have some memories of crowded longs also being at risk of even a small fundamental miss. The index hedging trades puts via SPY, IWM, and QQQs appear massively crowded. SPY has 893 million shares outstanding, yet the put open interest is 12.8 million contracts, implying a notional position size of 1.28 billion shares. How does crowding affect option positions as hedges? Can we adjust strikes and strategy to use the crowding to our advantage, e.g. tail hedges rather than callers? Many thanks.
Okay, there's lots of great things in here. Let's start with the first one, which is when the reader highlights the fact that Spiders has 893 million shares outstanding, yet has an option position of 1.28 billion shares. On most stocks, that matters a lot. It would if you were talking about Tesla or Microsoft, the stocks that are not easily replicable in terms of other assets, that matters tremendously. The thing about the spiders is just one way to express the view of owning or shorting the S&P 500. And the amount of outstandings of that ETF doesn't really matter.
Because they're just going to go into the futures market or
like
anywhere else.
There's guys that'll have long, millions of spiders versus short the S&P.
The dealers aren't using SPY shares to do their delta hedging. They're using the futures to do their delta hedging.
They might use them both.
They might use them both, but the point is that they're not constrained by that.
But not only that, if you think about it, you could actually short SPYs, SPY calls, and you could own all 500 stocks, or you could own the S&P 500 future. It's the same. And I as speaking like a guy that from the experience of a guy who did this in Canada, they all got put into one big book. It didn't matter, 50,000 of the ETF versus one basket versus how many futures. It was all the same to us. We just looked at it, and yes, there was like some issues in terms of funding. You had to adjust your funding, and there were some issues in terms of borrowing. But on the whole, it didn't matter. So the point is that you can't look at that. Now, having said that, the next part of his question is actually still correct in that how does crowding affect option position as hedges? And if we think back to Jem Carson and Brent Kachuba from Spot Gamma, this is what they do in terms of their whole service. They are sitting there looking for option positions that are large enough that they affect the underlying asset itself. And so one of the things that he asks is, can we adjust strikes and strategy to use the crowding to our advantage? 100%. That is what Jem Carson, he's made his living doing that. And he talked about this in our show. And if you haven't heard it, go back and listen, because he talked about the fact that when he went and he shorted a big option or bought, it didn't really matter. Either way, when he did a big trade with a whole bunch of other market makers and when the client was big enough, and he looked at what he quote unquote thought was his theoretical profit that he would make from it, meaning that if he was, selling a call spread and he was buying, 12s and selling 15s, he thought he should, and that thing should really be even up. Let's just say it was even up, and he should be making the 3 vol spreads. He never did. And the reason that he came to that conclusion was that when everybody was long, meaning all the dealers were long the same call option or put option, they would all gamma hedge. And that gamma hedging would limit the amount of volatility the market would experience. On the flip side, when everybody was short the same option, they would all be selling dips and buying rips because they would be trying to hedge the other side of it. So he came to the conclusion that it was not very smart to have the same position as everybody else, and what might seem like a fat option, meaning something that's trading with a high volatility versus the other options, wasn't as attractive as it looked, because if the reason that it was so fat was because a client had gotten everybody short at that point, that would be a situation where volatility might be higher than would be expected.
Yeah.
So the long and short of it is, yes, you can adjust your strikes and strategies to take advantage of that. It is a whole art in itself, and I highly suggest you go listen to the Jem Carson episodes that we had.
All right, one last question.
So last question here. Hey guys, love the show. I assumed you chose from thousands of questions from around the world, but less popular than I thought, so I'll get one in. Unfortunately, as a young investor, I succumbed to silver derangement syndrome. The Tin Hatters on YouTube led me to go all in on silver, going to 5 million tomorrow. Currently, my portfolio is about 50% precious metals related assets. I keep rolling SLV, GLD, and GDXJ leap options. It's like burning cash and offsetting the gains in the rest of my positions and trades. Painful to see my thesis of inflation be right and my vehicle be a dumpster fire, but I just can't ditch the trade thinking, as soon as I do, it's going to pop. FOMO to the max. Fortunately, now I know to take some gains as soon as the silver and gold laser eyes come out. Any advice on how to abandon or reduce a trade concept you're emotional about?
Do you want to start, Patrick?
Well, the
silver and laser gold eyes. For those who don't know, he's referring to the fact that when the uranium uranium eyes came out, laser eyes, that was the signal to sell.
Yeah.
And listen, just a little aside here. I have it on good authority that some of the uranium laser eyes have disappeared.
What?
And it might be time to look at the bull side again.
What?
Okay, yeah.
The laser eyes just disappear?
They disappeared.
Oh my God. That's
Yeah.
great. Anyway, so, I mean, obviously, anytime you take a concentrated position in one investment theme during a period when it is clearly not trending, any option strategy is going to have a theta burn. And the key is to come up with innovative ways to be able to help reduce that carry. One strategy that I've done in the past is, like, for instance, when a security is trading below its 50-day moving average, if I'm long a position, I always try to sell some calls up above to make it more like a spread, where I'm able to offset some of the carry costs through earning a little bit of income. I mean, you could do innovative things to help try to reduce that carry cost, but especially if you're doing out of the money option leaps on them and waiting for them to rip, that's going to obviously have a heavy carry, right?
Okay, so I got a story to tell, and it's going to make me sound like a little bit of a douche, but I'm going to do it anyways. So I play squash, and I just wasn't big enough to play hockey.
You're a douche, just right
yeah,
there.
I am. Like I might as well be called Chad. And I remember one time I was talking to my squash coach. And for those who don't know the game of squash, you go in this little room and you chase around this ball. But one of the keys is that you always go back to the middle, what they call the tee. And by going back to the middle, you can get yourself in a situation where you can get whatever the next ball is that's hit. And if you find an opponent that, for example, doesn't go back to the tee, you can hit it to wherever he's not going. And as you get better, it could even just be how they're leaning. But when you're first starting and when you're not very good, it could be that you're hanging back and you're 2 steps behind. So
we are talking gold here, right?
Yes. So I'm going to get to it. I'm going to get to my point. So at one point I asked him, and I said, well, I was asking my coach, and I said, okay, we had a rally and I stopped it. And I said, after I lost, and I said, okay, what did I do wrong there? Like, because I lost that rally. And I said, obviously I did something wrong at the end. And he said, no, you actually lost it, 2 or 3 points before. And the reason you lost it 2 or 3 points before was because you didn't go back to the tee. So I didn't. So even though, the reality was that the final problem that caused my loss, me losing the rally, wasn't that I didn't do the final shot correctly. It was that I had previously not set up correctly and not done the fundamentals, meaning going back to the tee. Which brings me back to this reader. And he's now sitting there and he's in a situation where he has 50% of his portfolio in these gold options and he's just bleeding and it hurts. And as tough as this sounds, there is no real solution to your problem. The real solution was to go back to the tee or to never get yourself in that solution. So you should have had a trade plan in front of it to make sure that you didn't go and invest such a large amount of your portfolio in that one theme. And you always have to imagine, as the great traders, if you talk to any of them, they all are worried about what if they're wrong. What if they're wrong? And that is what you always have to ask yourself. What if I'm wrong? And unfortunately, you're now in this situation. And I listen. I sympathize. Every trader has been here. The reality is that when you finally do puke it out, it will be the low. Like it just like it will. And it's just the way the market gods work. And I'll give you one last story that we used to I used to trade with the guy on the floor in terms of when I was at the bank, and we would run this. He would do the futures, I would do the upstairs trading, and we would get situations where people would ask for bids and offers on big baskets, and we would have lots of risk. And if we ever got ourselves offside, we would sit there and we would say, okay, we're offside. This sucks. We've screwed this up. Let's sell a little bit, to just see if we can appease the market gods. Like if we just sell a little, maybe that'll be enough. And sure enough, we'd sell a little and no, it'd keep going against us. And we'd sell a little more and sure enough, nope. And it wasn't until we sold it all. And the market gods always knew what the end was. So I wish I could tell you that there's some sort of solution and that you could fix it up with doing all these sorts of option trades and you can do it by selling theta and stuff. But the reality is you're just going to make, you have a good chance of making things worse. Yes, you could make things better, but at the same time, there's a good chance you can make it worse. So what I would suggest to you is that you go and really think about making a trading strategy before you put the trades on. And one of the things that I always said when people had errors or a position that was moving against them is I would tell them, have it until you're thinking straight. And then if you still aren't thinking straight, have it again. And that's the real problem, is that when you have a trade that's against you, going against you, is that if you can't think straight, you'll find yourself making bad decisions. So my suggestion is it's going to suck. You're probably going to sell the lows. Just start unwinding until you can think straight.
All right.
There you go.
Words of wisdom from Kev. All right. So, Lena, where can they submit their questions?
If you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right. That's a wrap.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're on Twitter every day. Give Lena a shout out. Wish her well on her new marriage. Don't bug her next week, though. She does get tired of talking to Patrick and myself. And listen, you can check out Market Huddle on all the networks: Google Podcast, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our content. And if you could, please like and review us on iTunes. You know why. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna and at bigpicturetrading.com. And Kev, where can they subscribe to your fantastic newsletter?
I got something to tell you about this after, but a second. I'm on Twitter at Kevin Muir, and you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, so before we do the beer, we haven't actually spoken about our sponsor. And I was laughing, Patrick. Well, you're doing such a good job. I'm pretty sure that you're going to be pitching mattresses next. You're just as good as Jim Grant.
Really?
Jim, have you ever heard Jim Grant?
Yeah.
Jim Grant will go and he'll be sitting there talking about the bond market, and then he'll say, you know what? You know what gets me, helps me sleep at night when I'm worried about interest rates? My Casper mattress. Now, we should explain. We love Rob Koifman at Koifman, and we are taking we've taken his sponsorship, and it is all going for the piss up. Just so everybody knows, the funding is going for the piss up. And we believe in the product. We think it's great. And I'm a big fan of his. And I think that we are all better off if he succeeds. He's a great guy, but also we're all better off if he succeeds, because we could use a competitor to Bloomberg. Yep. And so we love him as a sponsor. We love having him on the show. And just so everybody knows that Patrick is
here.
Patrick's doing a great job, and he's going to be pitching Casper mattresses next. You are good at it. Let's do the beer. So right. Could you remind me again, if I met this, is this one of your members that has given us this beer? Exactly. Have I met him, or is he just...
No, he's out in Europe. You haven't met him out in Europe, so...
I know, but you had some members that have actually come to see you.
Yeah, no,
They're foolish enough that they actually come to see you.
I went to see them. I was
okay.
enjoying
That's
Vienna.
true. That's the client customer relationship should work.
there you go.
Okay, so now, what is this? So one of your guys gave you this, and what country is this from?
Hungary.
Hungary, but it's a Molson beer.
Owned by Molson, yeah.
Yeah, so Molson's just everywhere.
Yeah,
Goddamn.
they've been scooping everything up.
Crafty Canucks.
And you know what, though? I actually have to say, it's actually a delicious beer.
It is a delicious beer. Like, I'm with you.
Like,
so we're going to
it's,
agree on this.
Yeah.
Now, I think you're going to be a little partial because
I'm not going high on it, but
well, no. Oh, really?
well, look. I remember my rule is the 7.5 is a right down the middle straight thing. I'm gonna give it a 7.8. I'm gonna go a little bit higher than that.
You're so boring now. Okay.
No, I am not boring. I am going to save that really good score for that one beer that we're gonna drink,
So
and every
boring.
one of our listeners are gonna know that beer mattered because you giving everything 9.2, 9.7.
I rarely
No
give
one
nines.
knows whether to buy
No.
the beer that
What do you
you're
mean?
freaking
They know
promoting.
when I give like. Have you ever given anything sub 5? No, you don't have the balls to do it.
Oh, I just had.
You do not have the balls. You have not done
I
any
gave
sub
that
fives.
banana. Banana bread beer was under 5.
Oh, maybe you did. Maybe you did. But that was the wrong call, though. You've given none of the bad beers. The banana bread beer was awesome, and I don't like. Listen, I didn't think I'd like the banana bread beer
All right,
either.
just
Lena,
score
let's
this.
Lena, what are you doing?
I'm not drinking the beer because I'm on bridal diet.
Oh, okay, completely understand.
All right, so
Okay, I'm
give
going
it
to
a
do
score.
this. So, it's good. It's good. It's way better than it does not have a 7 handle. It has an 8, and I'm just trying to figure out where in the 8 handle it has. I'm going to give it 8.5. 8.5. Good beer. I really like it.
That's a high mark for you.
Yeah, no, it's a good beer though. I like it. It's just it does its job. It's good.
So I'm back in the city.
Yeah. Okay. So now we got to talk about this.
Yeah.
Back in Toronto.
You're back in the city. We went and razzed you quite hard about not having killed anything. And for those who don't know, Patrick went hunting last week. And I guess the market gods were listening
Yeah,
because we
you guys
razzed
were
you hard,
taunting
and
me.
then you come up big.
Yeah.
And,
There's the picture on the screen there, and
you killed some poor mama moose, or no, you're
No,
not allowed to
no,
kill mamas.
what-
It's Papa
that's
Moose, right?
horns. That's a bull.
Oh, yeah, that's right.
No, I marked the top of the bull market. I killed the bull.
There you
I
go.
killed the bull. It's done. It's a bear market now.
You know what? I must admit. Okay, so I'm not a hunter. I have trouble enough killing the fish that I catch. But there is a little part of me that is quite excited about having some moose steaks.
Oh my God! I had the moose
Was it
steaks.
good?
Oh, it was so delicious.
I can't believe you already had one without me.
Yeah, you know what? I have an entire freezer full, man. It's unbelievable.
I'm coming. Like I want.
You get a moose
between
steak.
even after splitting among 7 guys, I still had something like freaking 40 kilos of moose meat that I had.
Yeah,
I
no,
had to
moose
fit
is
into
a
my
lot.
freezer.
How do you guys
Like-
decide on the cut? Does everyone get a few different cuts?
Yeah. When the butcher, after we field dress it, you take it to the butcher and they go do all the proper processing of the meat so that it's very, you have your grounds, you have your stewing meats, you have your roasts, you have your steaks, the whole works.
So okay, so did you keep a tenderloin for me?
I've got steaks, yes.
Okay.
Not a tenderloin. The tenderloin, that was, no, I do not have a tenderloin for you.
What, you gave it
I'm
to
not-
somebody else?
I'm not saying anything. You're not getting a tenderloin.
Okay, so you got a tenderloin. You just say not giving me any of it. Okay, fair enough.
You're getting a good moose steak.
Okay. Okay. What, the tenderloin's already in your belly is what you're saying.
There's,
That's the
anyway,
rumor.
so nonetheless, Lena's getting married.
Yes.
Let's change the topic. The
Or am I wrong? And the moose doesn't have a tenderloin. They
no,
all
it
have
does. It
tenderloin.
has a wonderful tenderloin. Anyway, the
It was delicious in
So-
my belly.
so I am literally 10 minutes away from Luke and the entourage all arriving here for Luke's bachelor party. For Lena is going to be at home while I'm going to get Luke sloshed.
So have you got the reservation at the Sundowner?
No. No. I'm not going to comment on anything that's going to happen tonight. All I know is, Lena, you be ready for Luke to. He's like, just open the door, let him fall into the front foyer, and just leave him there. Just have a pillow ready for him.
Luke the Puke will make an appearance tonight. I'm fully prepared.
Luke the Puke.
He's listen. It's a bachelor party. Shit's happens. Like, you stopped drinking for like 20 years after your bachelor party, Kev.
Well, I didn't stop drinking. I stopped drinking, and I still can't drink hard alcohol because it was literally this Bond trader.
They broke you.
They did. It was this. What's the thing James Bond drinks all the time?
The gin martinis.
Yeah. Oh, Jesus. Like, I had one of those, and it's bad news. And then my bachelor, we rented a bus. My bachelor party, we rented a bus, and it started early, and it just, I think they dropped me off at 8 o'clock. We didn't even make it to the first one. It was so bad. I was a bad shape. And yes, you're right. I do not drink hard alcohol, and it's basically because of that.
Oh wow.
It was a bad evening.
You know what? You're putting
though.
a big Debbie Downer on what's supposed to be an awesome night. I'm ready for a great party, buddy.
Well, everyone else had a great time. It was one of those nights that literally, like, I hear about all the time.
You just wait. What if Luke the Puke comes out while he's with you guys? You just wait.
Oh, no, don't worry. That's what the Uber driver is going to have to deal with. The moment he starts showing the sign, it's like reading the tape. You can look at him and the way he's.
I can read the tape. I can see the boot.
You can see the way that he's swaying and the way that he makes that burping sound. And it's like, there's something gonna happen. Uber, done.
That's going out with peer pressure. Peer pressure, Pat and Luke the Puke does not sound like a good night. I can just imagine the bad decisions that are going to happen tonight. For those who don't know Patrick, he just literally has the worst. I trust my 16-year-old to do better, smarter things than Patrick.
Come on.
No, honestly.
Come on.
Okay, so let me tell the story. I haven't gone out lots of nights drinking with Patrick, but I've gone out some nights. And literally, we go to Chicago. He's got some of his friends there that he knew growing up.
The
It's a lot of fun. The entourage is all there. Yeah, he literally is like the guy. He has an entourage that he brings around, and it's kind of weird, but he does it. And I guess he just needs a wingman to chat him up. Anyways, I go to Chicago. I get there. We go out drinking. It's like midnight. I think we're speaking the next morning at 8, like at this Chicago conference or whatever.
It was
I'm like,
Expo,
okay, let's start
Expo.
thinking about going home, and I'm sitting there and I'm like, no, like Patrick's, no, keeps us out till 2. We get home at 2, and then he's like, he's like going and finding some bottle to open up at like 2 in the morning. He's like, no, don't stop. And I'm like, get away from me, you're insane. Like, he just, and for those who don't know Patrick, he gets tipsy really quick. He really does. He gets tipsy really quick. But then he literally goes for days, like just drinking, and it's kind of strange. Like it's. Oh
my God, you're making me sound like an alcoholic.
Well, okay. But
wow.
I just no. It's just the decision making is sometimes a little suspect. That's all I'll say.
Oh my God.
Do you disagree?
No. I disagree. I have been always in control of everything.
So I'll you know what the perfect example of? I'll give you like your entourage.
Like, think about it.
They're not all your age. Like, you're literally like your entourage. Lots of younger guys. The reason that there's younger guys on there is because all the older guys have already tapped out and said, "Hey, listen, you know what? I know better than this." And Patrick's like, "Oh, geez, I got to find some younger guys that don't know better than this. I'm gonna go find some new younger guys."
He's got like
Lots
a
of fun.
bionic liver or something.
Yeah,
Problem is-
it's lots of fun. You just don't want to just don't do it on a regular basis.
Dude.
Anyways, that's my little bit on. So I'll
Dude,
let you guys go.
For what you said there, let's be realistic. When we went on that stage in Chicago the next day, I was in top form.
Yes,
I
I'm
crushed
not-
you.
I don't disagree. You know what, Patrick? You handle it. As I say, it's kind of surprising because you seem like you get drunk really quick, and then the stamina on you is unbelievable. You're like the marathon runner of drinking. That's how
you
I view
have
you.
to train the liver, and you sometimes have to have a liver transplant and then you just got to train it up again.
You got to train the next one. Anyway, so I'll let you guys go.
Yeah,
Have fun. I will hear the stories, or we won't. Because maybe Lena won't want to hear them. We'll have to
But
hear
listen,
them.
everyone.
I'm okay to hear them all. I
one-
just hope they all remember.
So no episode next week, but the week
Oh,
after,
yeah, that's right.
when we are back, if there was anything good, I will make sure we share some stories.
Okay, sounds good.
All
Lena,
right.
all the best on your marriage.
Yes.
You and Luke are wonderful people, and everyone at the Market Hall wishes you all the best in your future lives.
Thank you.
Agreed.
Thank you so
Wish
much.
you so much success and happiness and all that other crazy stuff. All right. Thanks, everyone. All right,
Take care.
cheers.
Bye bye.